Good afternoon, everyone, and welcome to Group 6's presentation on a financial analysis of NextDC. Throughout this presentation, you'll hear from myself, Jordan, as well as Lee and Martin throughout the rest of the presentation. This presentation will consist of 6 sections, and they will be broken down as per the contents on your screen. Firstly, we'll talk through business strategy, then accounting analysis, financial analysis, then we'll dive into the forecasting, valuation, and an investment recommendation. The data center industry underpins our digital economy, and it's experiencing transformative growth. Cloud computing, AI, and the rise of big data are driving demand. The industry is seeing consolidation for scale, a crucial focus on sustainability, and unique geographic and regulatory challenges within Australia. Cloud adoption continues to accelerate, while a skilled workforce shortage remains a key concern. The data center landscape is rapidly evolving, presenting both opportunities and challenges as we shape the future of our digital infrastructure. While NextDC holds a strong position in this dynamic market, the road ahead isn't without its obstacles. Global giants like Equinix and Digital Realty pose a constant challenge, forcing NextDC to leverage its local expertise and superior service to stay ahead. Additionally, fast-growing regional players like AirTrunk demand continuous innovation and strategic expansion from NextDC. However, there is significant opportunities for NextDC to grab a hold of. Opportunities such as the immense growth potential within our industry. The Australian market is booming as businesses turn to outsourced IT solutions. This expansion offers room for strategic growth both domestically and within the dynamic Asia-Pacific region. With the industry on a clear upward trajectory, NextDC is well positioned to ride this wave of digital transformation. Investors need to be aware that accounting standards offer companies like NextDC some flexibility in how they report their financials. This is necessary for innovation, but it also means judgment calls can influence the picture of profitability. Two critical areas to watch are capitalization versus expensing decisions and revenue recognition practices. If NextDC aggressively capitalizes costs or recognizes revenue prematurely, it might boost short-term earnings but create a burden in the future, impacting sustainability. This doesn't mean there's manipulation, but it requires a critical eye. Look for warning signs like earning growths outpacing cash flow, unusual accounting choices compared to industry peers, or concerns highlighted in the audit report. When forecasting NextDC's future, it's crucial to adjust for the potential impact of aggressive accounting. Normalize earnings by considering the eventual hit from capitalized expenses, and assess whether revenue recognition is truly aligned with service delivery. This cautious approach leads to more reliable forecasts, ultimately protecting your investment decisions.
NextDC achieved total revenue of $363.2 million Australian dollars in financial year 2023. This represents a 25% increase year on year and compound annual growth rate of 22.4% between 2014 and 2023. NextDC's strong growth trajectory can be seen in the graph to the right of the screen. This growth is currently 1.5 times its closest competitor. In terms of profitability, NextDC has strong earnings before interest and tax results with $48.6 million in 2023 and between $25 and $55 million over the last 7 years. This result is after significant depreciation write-offs. Net income is negative though, with interest expenses totaling between $46 and $68 million in each of the last 5 years. ROE averaged negative 1.3% over the last 10 years, driven by negative net operating profit margins. Net operating cash flows were $126 million in 2023, with between $133 and $126 million over the last 3 years. The positive cash flow is much smaller than the cash outflows from investing to fund the rapid expansion of assets. Financing has steadily increased to fund the investing. Financial leverage is fairly consistent around the 1.5 to 2 mark, with debt to equity ratio averaging 60% over the last 10 years, with 75 and 70% in the last 2 years. NextDC has no liquidity issues, with current and quick ratios showing almost 10 times the current assets against liabilities. Free cash flow to equity holders starts at negative $811 million in FY20 due to investing outflows. Forecast free cash flow spikes strongly negative through until the rapid investment stabilizes in FY29. From FY29 through until the terminal stage, free cash flow grows steadily to roughly 1 billion Australian dollars. Key assumptions for this forecast include rapid facility growth leading to 23 facilities in FY32, the largest being Sydney's S4 with 300 megawatts of data center capacity. This expansion represents a 6x growth in installed capacity between 2023 and 2032. Contract utilization expected to remain high with 90% of capacity contracted in the terminal phase, with dips as new capacity comes online. Billing customer utilization is expected to remain steady at 70% as customers rotate and new capacity comes online. An efficiency factor of 5% has been added, assuming that NextDC can increase the revenue per megawatt of data center capacity by increasing computer density and upgrading technology to the most efficient available on the market.
The valuation of NextDC was conducted using two methods. As we can see on the left-hand side, comparable companies method arrived at a value of 1.5 billion and discounted cash flow arrived at a value of 8 billion. Both of these valuations were below the market capitalization as of the day making this presentation. For comparable companies, we selected a peer group consisting of 8 global competitors. We decided to use a PE ratio to derive the equity value, and we landed at median of 82.8, which we applied to the PE multiple. For discounted cash flow analysis, we use discount rate, which we calculated by capital asset pricing model, feeding it with Australian 10 years bond, risk premium, and beta coefficient sourced from the market. An important aspect of this valuation is terminal value, as it holds all the positive value in the valuation. We are using a perpetual free cash flow to equity growth rate of 5.5% to derive the terminal value. In terms of sensitivity, there is a big disparity in a small decrease in the growth rate from 5.5% to only 3% that would result in negative 65% in the equity value, and that value would have been 2.8 billion only. If we apply comparable companies multiple of 82.8 to the terminal value, we will arrive at a valuation which is much higher and amounts to roughly 35 billion. The investment recommendation our team makes for NextDC is based on 3 key levers. The first one, business strategy, we see as a green check mark because the company is well positioned in the Australian market and delivering the right technical parameters to its customers. The second one, sales growth continuation, we see as an ambient question mark because the market is being penetrated by global competitors, and based on that, it will be more difficult to deliver the anticipated sales growth. The first one, uncertain profitability, we see as a potential issue, as in the recent accounting periods, the company hasn't delivered any free cash flow to its equity holders, and also in our forecast, this remains negative into the few more years ahead. Based on these 3 levers, we recommend the shareholders of NextDC to hold their shares and closely monitor the future developments in sales growth and profitability.